While investors were chasing the hottest AI stocks, I made the opposite decision. I concentrated my portfolio in quality companies whose stock prices had been beaten down. 1 month later, my portfolio was up roughly 7.7%, while the S&P 500 gained only about 0.5%. So, what exactly did I buy? And more importantly, why was I buying the stocks Wall Street was avoiding?
1 month ago, this account was worth approximately $110,800. Today, the portfolio is worth approximately $119,200.
It gained about $8,500 and roughly 7.7% since the journey began. 3 positions drove most of that performance. Palo Alto Networks gained approximately 29%. Meta rose around 14%. And ServiceNow added about 10%. So now you know what I bought. Here's exactly why. Hi everyone, welcome back to Precision Capital. This channel is a public record of every investment decision I make as I attempt to turn $100,000 to $1 million. I share my trades before the outcome is known, along with the thinking behind every win and every mistake. So if you want to follow the journey and see how these decisions play out with real money, subscribe to the channel. 2 months ago, I had a choice. I could chase the same AI stocks everyone else was buying, or put real money into strong companies the market had temporarily turned against. I chose the second path, and Meta is the clearest example of the thinking behind that decision. My decision came down to 3 things: the business, the valuation, and the chart. First is the business. We all know Meta is one of the strongest businesses in the world. It has a wide economic moat and owns Facebook, Instagram, WhatsApp, and Messenger. Billions of people use these platforms, and businesses around the world depend on them to reach customers. But that is not the most important point. The real question is, at the time Meta's stock price dropped, was anything actually wrong with the business? Was revenue declining, or did management reduce its growth expectations? The answer was no. As you can see from this financial performance chart, Meta's revenue was still growing, net income was increasing, and free cash flow was continuing to move higher. The stock price was falling, but the underlying business was still improving. That distinction was extremely important to me. The second reason I bought Meta was valuation. Through my research, I estimated Meta's intrinsic value at around $820 per share. For a quick reference, you can also check valuation sources such as Guru Focus or the fair value information shown in Robinhood. Now, here is the interesting part. If Meta's fair value was around $820, why weren't investors rushing to buy it when the stock was trading near $600? That is one of the most important lessons in investing. Market price and intrinsic value do not move together in a straight line. As you can see on this chart, the straight line represents intrinsic value, while the blue line represents the market price. Sometimes excitement pushes the stock above fair value. Other times, fear pushes it below fair value. As investors, where would we rather buy? Up here when the stock is overvalued, or down here when it is undervalued? The answer should be down here when it is undervalued. That is how I viewed Meta. When its price declined well below my estimate of fair value, I used the opportunity to accumulate shares at a better price. The third reason came from the chart. Fundamentals told me what I wanted to own. The chart helped me decide when the selling pressure might be weakening. During the pullback, Meta stopped making lower lows. Instead, it formed a higher low. In simple terms,
Buyers began stepping in before the stock could fall back to its previous low.
That suggested sellers might be losing control and that the direction of the stock could be starting to change. A higher low does not guarantee that the stock will move higher. No chart pattern can guarantee that. But when I combined the improving price action with a strong business and an attractive valuation, the risk and reward started to look much more favorable. So I did not buy Meta simply because its price had fallen. A falling stock can always continue falling. I bought because I believed the business remained strong. The market price had moved below my estimate of fair value, and the chart showed early signs that buyers were returning.
I saw the exact same setup in Palo Alto networks: a strong business, a price below what I believed it was worth, and a chart showing buyers stepping back in. Same story with ServiceNow. The business wasn't cracking. The market had just mispriced it. 1 month later, all three were up double digits. That's when I knew I wasn't betting on one stock. I was betting on a repeatable process across 3 different companies.
But Meta, Palo Alto, and ServiceNow weren't my biggest bets. I have even more money sitting in a different group of stocks, built on the exact same thesis: strong businesses the market had temporarily given up on. Except this time, the market still hasn't agreed with me. These stocks haven't made a meaningful move yet. Some are still trading near where I bought them.
And because I sized these positions larger than Meta, Palo Alto, or ServiceNow, if I'm right, they could be the biggest move this portfolio has ever made. If I'm wrong, they'll cost me more than any decision I've made on this channel so far. So here's the real question heading into next month. Was this month proof that the thesis works? Or was Meta just the easy one? Next week, I'm showing you exactly what I own, exactly how much is riding on it, and what has to happen for this to actually pay off. So subscribe and turn on notifications to follow the decisions before the outcome is known. I also post every trade and portfolio update on the Community tab, so you can see what I'm doing between episodes. I make the decisions. The market writes the ending. I'll see you after the market closes next week.